Welcome to this episode of Market Shares. I'm your host, Tony Blodgett, and I'm back with Anton Stetner. But let's pivot a little bit here, Anton, and talk about what does this really mean for interest rates in the short term? Because here we are on recording this the Monday after this happened. Today is March 13th. But, mortgage rates improved pretty significantly today. We saw MBS prices at the 5.5 coupon up. It was up about 120 basis points this morning, up close to 80, I think, at the time of this recording. It's a huge move for one day. We also saw a pretty big move on Friday with the employment numbers that came out. So big move Friday, big move today. I mean, rates have definitely gotten better. Mortgage rates in the last couple days. My prediction is that we continue to see them get a little bit better. And so that's good news. We're just heading into that the spring home buying season. We were kind of thinking that we were going to be, there was going to be this undertone of the highest rates that we've seen, really kind of matching where we were back in, October, November of last year. But now it looks like we're going to see a little improvement. And my guess is that we continue to see improvement. Again, like everything, I explained the whole yo-yo theory. It's not going to be in a straight line. But this was a big move in rates, and I think they continue to get a little bit better. What are your thoughts?
I think that from the real estate side, below 6%, the market is on fire, just due to lack of inventory. And it's sustainable up to about 7.
Right.
So as we back away from 7, for that consumer, the further we back away from 7, the hotter the market gets, just due to the low inventory and we talked about this before, and what I missed and what I've had a mistake on. And my mistake was kind of simple now when I look at it in hindsight. I underestimated just the number of transactions that we have to do for life events, job relocation, job transfer, having a baby, divorce, the good and the bad life events. That is keeping a large base level of transactions going. Now, we're not going to go do, a national level, over 6 million transactions again. I believe we're going to be, 30% less than that even here locally. But that's still a good year. That's a 2017, 2018 transaction volume year. We just have to get more skilled on the lending side, more skilled on the buyer and seller side, and get into real estate and having those dialogues. But right now, market's on freaking fire.
Yeah. So, and I definitely think rates, you're right. You start flirting at 7%, things slow down.
It hits a ceiling, it just
it's like a wet blanket on everything. So I think we can be assured that we're pulling away from that. I feel pretty optimistic that rates are going to continue to improve. And if you got your rate sheet today or whatever, don't be surprised if you didn't see all of that in there. Your capital markets team isn't going to push through all of those gains. There's so much volatility. It would be dangerous for them to do that. It also, makes loans that are floating have risks and so on and so forth, or loans that are locked, and the transaction's not closed. There becomes challenges there with float downs. It's problematic. It's expensive. During a market like this for your capital markets team, if you're a mortgage guy. So don't be surprised if you didn't see all that push through to your rate sheet. But I think as we see some consistency, I think you're going to see that improve. I think we touched on the Fed. I think they're going to stay the course. Don't think that they're going to immediately pivot.
Even if we want him to change, he's going to
keep going.
Yeah.
Unless something, if we start seeing bank after bank after bank, really start failing, they may have to do something on a bigger scale. But this credit facility they put in place is what the banks needed. They're now saying, hey, if you need to sell assets to raise money, we're not going to make you write those down. We have a facility for you for that. That's huge. That really should solve most of the problem. Backstopping the first couple banks and saying to your depositors, all depositors will have access to their funds. That's what they wanted to hear. I think that curbs the fear here, but it does mean to me that when the Fed can, they are going to bring rates back down. So,
And do you think now, the FDIC is going to change, and all of a sudden we're going to have, and I'm making this up, but we're going to have small business, maybe we have a FDIC insurance for a personal account, and then we have a small business FDIC insurance and then big business FDIC insurance, and they're slightly different rates that are paid, but all of a sudden you got $250 on a personal, and let's just say $5 million for a small business, and maybe like up to 10 or 20 million. I think we're actually going to see some sort of fundamental regulation. So I'm not always worried about what they do to save something. I'm actually more thinking about, okay, what's the next 7 dominoes that come into play? So do they change federal deposit insurance here? And then does this set a precedent, like, well, and not to be super negative, but like, well, any bank can just fail and the Fed will save me.
Right.
Well, that gets reckless and dangerous.
Right.
What are your thoughts on those two, on the FDIC and the precedent that's being set here?
Yeah, I'm probably, I'm not an expert enough on those things. I will tell you that you're right. Every time we've seen any sort of a bailout type situation, or where the Feds had to step in, typically that is then followed by some regulation that keeps it from having to happen in the future. Yep. So from that perspective, I think that's a reasonable way they might deal with it. I wouldn't even be surprised to see, just FDIC insurance go high. Look, basically what they just told everyone is, 250. I mean, like that means nothing. Like if you have $1 million at Silicon Valley Bank, you're cool. You know what I mean? You're taken care of. So the 250 thing, maybe that even just changes across the board. I don't know. But yeah, to have different classes of FDIC insurance, I think that's very reasonable. Here's something else I think that's going to change is, right now there's certain regional banks where if I want to go get a loan from them, and I'm willing to put a bunch of my funds into their bank, yep, I can get very favorable interest rates on that. And it's made it very, the banks have had a very, competitive advantage on jumbo loans and some of these non-conforming loans, because they'll just say, hey, if you have $10 million and you'll come deposit, $2 million at my bank, I'll give you whatever, kind of loan you need, and we'll do it at these certain terms. Well, all of a sudden, you got to start questioning, if I got my money over here at the Big Four and I want to get this exotic mortgage loan and they're willing to give me really favorable terms, but I got to put $2 million in their bank, all of a sudden I'm questioning the solvency of that bank, and is it really worth that, right? Yeah. And now you're going to ask me to bring over funds that are above the FDIC insurance level in order to get favorable terms on a mortgage or another loan, and that's unprotected assets when I don't
times 100 people. How big is this problem?
So I think what it does though is it makes those banks have to, first of all, charge higher interest rates. Part of the problem is some of these banks are doing rates too low because they're portfolio type funds and they're not recognizing that their arbitrage is negative. They have negative arbitrage on dollars that they're paying out versus what they're lending out. And so that's going to be a problem. So I just think you see those rates go up. It's actually going to benefit those of us in mortgage finance that don't work at small regional banks, because they're going to have less of a competitive advantage on some of those products. And I think it's just going to be, it doesn't look good for a bank to say, hey, bring $1 million over here, knowing that 75% of that is not protected by FDIC insurance, when you don't know the overall solvency of my bank, and the rates that they're offering aren't that much of an advantage. I say advantage to independent mortgage bankers in that case.
And this is something that as real estate investors, you need to really be thinking about. So as a real estate investor, you're going to a lot of these small banks.
They're tightening.
And they're going to be tightening.
Yes, sir.
So you're going to get pinched. Okay. You're going to get pinched if you need the money now or today or on a refi, or you're finishing a development project, whatever it may be. Flip it around. That pinch by those regional banks on other investors is also what will create opportunity over the next 6 months to be a hardcore investor.
Right.
You just have to have your pencil really sharp, and I'd have my takeout financing lined up in advance. Even if you got to pay to lock it over a long duration, it's worth that safety and security, because what if that bank was offering you a phenomenal rate and then they get pinched a little bit by the Fed? Now, as an investor, you can't get that takeout loan.
Right.
So find the deals like usual, and I think lock in your long-term financing right now, just to make sure it's going to be there.
That's a really good point. I love your perspective. So yeah, I look at it from the perspective of as a person getting the loan, you may not get as favorable terms, or it may be too high of a risk just to get a little bit better rate to move your funds over. What Anton's talking about is if you're an investor, you're used to going to these banks for these types of credit facilities, and they're going to have to tighten up. Whether it's the Fed or just their own, internal risk people are going to be like, okay, we need to be careful. They're going to start making less risky loans. They're going to start requiring higher interest rates on those loans. And then you're right. That's going to create opportunities where an investor's caught in the middle. Maybe they have hard money financing they were expecting to get out of. There's all sorts of different places where that could rear up and be an opportunity for the right investor.
Let's get real specific for the audience. Someone who's sitting in hard money, someone who is in a construction loan or a development loan or a value add project. Any of those types of ones need a takeout on the back end, and those are the people who are vulnerable to being pinched during this transition.
How do you find those?
I think you get on social media and you call everyone you know. I mean, this is an opportunity. We may or may not be doing this right now.
Yeah. Reach out. No, but that's a really interesting real interesting point. Well, yeah. So if you're relying on regional, look, I think regional banks are critically important. Don't get me wrong. I mean, I have friends that work at regional banks, and I think that they're taking a lot of a hit right now, and I think it's part of it, like I said at the beginning, a lot of this is bad players. I mean, I'm sorry, but SVB was just not well ran. Some of these other banks were not making good decisions. That's not all regional banks, but they're all taking the hit. But there will be repercussions, and they will have to be a little bit more careful moving forward, and that will create opportunity, to Anton's point. So let's talk about how this is going to impact the real estate market as a whole.
Yep. So right now, even before this, it felt like we were coming into the spring market early here in the Seattle metro. And all of a sudden it was heating back up. Now, like we had said earlier, I do believe this year is going to be 20 to 30% less transactions. Previously, when we had talked about this year being slightly flat or slightly down. I think this year is going to be slightly up at this point.
Yeah.
And you're seeing the long-term price stabilization. There's a metric called the original list to sales price ratio.
Right.
In other words, not what it was listed at the last time, but what it was listed at the first time versus how much it sold. That gap closed back down, and that's back towards the long-term historical average, which is around 98%. At 98%, you have long-term price stability. There was a big gap in there that got as low as 94.
Yeah, okay. Remember, we talked about this.
So it was showing the market essentially trending down because of that. So that closed, plus just anecdotally, on my own personal sales team and the brokerages that we have, you're seeing activity pick up. We've also been seeing, I would say that this has turned into like the tale of three markets with the move-up buyer. So start at the bottom. You've got under the median, you've got move-up buyer, and under the median being first time. So first-time home buyer, move up, and then luxury. And then I'm just going to say luxury is 25% higher than the median in your area. That luxury market is kind of dead, and there's some good opportunities in it. Now, parts of it are still stupid hot. So a deal's a deal in any market, and know what you're shopping for. That move-up buyer and seller, they've been taken out of the market. It's very, very difficult to go to your move-up seller and say, hey, I want you to trade in your 3% mortgage for a 6.5. Just, Johnny 5 does not compute. Like, it just doesn't work.
Right.
And that bottom part of the market, or the first-time home buyer market, is on fire. So last week, we put on 2 first-time homebuyer homes. Both of them ended up in bidding wars. One of them received 10 offers, and it sold for $55,000 over list price.
Here we are.
On a certain level, that worries me.
Yeah, for sure.
Very happy for the seller. Buyers also in love with it. And yet, I don't know that I want to see those bidding wars. But because we don't have enough inventory, we're still in that same inventory problem we had talked about, a long time ago. We are not building enough houses to keep up with demand. So here in Washington, there are 50 housing bills in some form or another in legislation right now, the most we've ever had. and is trying to get to, how do I deal with this affordability? How do I create more housing? The main problem that we're running into is there is not enough developable land and too much regulation. So it just takes too long and costs too much.
Yeah. So what I heard you say, so two things. One, on that listing versus what they're selling for gap closing.
Yep.
We talked before about this, and we thought there was quite a bit of opportunity to get the seller to pay concessions, fund your buy down. Less of that. Gone. Okay. Well, that was we told you it would be a short window.
There was a phenomenal opportunity for 4.5 months.
Yeah. Okay. So that window was short. And again, this is what I want to get out to people. Like, there's a reason why now is the best time to buy, is because these pressures that Anton's talking about, if rates really do come down as we're predicting, it's going to get even worse.
Yep.
But I want to ask you this question. What does it take for the move-up buyer to become non-existent,
Not locked in.
Not locked in.
Yeah, I think for that move up buyer. So generally speaking, when they move up, their payment's going to go up between like $600 to $1,200. That's kind of like a normal number. It's double that now.
Right.
Sometimes more. So they need,
because they're going up in price and they're going up in rate.
Bingo.
Yeah, it's a double whammy.
Price and rate. So
Yeah.
it's beating them up twice. Thank you. That's a really good way of saying it. And I think that this goes back to kind of what I was saying earlier. Those people need a life event. Oh, we just had a baby, or we just had our second child. Now we need a bigger house. I just got a promotion at work. So that's more of what we're seeing is causing that move-up buyer to, I'm going to sell and do, is life events. I don't know that there's a magic metric we can talk them into. Now, if they're at the top end of the move-up, though, and they're starting to scoot in
The luxury market.
into that luxury market,
And there's deals there.
there's deals.
Yeah.
And so, once again, I think it's market dependent, case dependent, and let's go find the deal. So this is something I was telling all of the agents in our brokerage. Like, we get so used to hunting for a deal just on the MLS. Well, this is also the market where you might have to get off of I-5, aka the MLS. You might have to go on a dirt road and go hunt something down. And you do that through social media, cold calling, direct mail, door knocking. But today is the market where you're going to have to go hunt something down for your seller in that move up category so that you can make it work for them. And then you're going to have to get creative. You're going to have to get, like we said before, hug your lender, talk to them all the time, and start to figure out, okay, what would numbers work for this client, and then go build the scenario backwards.
Right. Well, so I think what I'm hearing you say is that if you're on the upper half of the move up category, it could work for you that if interest rates are coming down and you're touching that higher end luxury market, you could actually see the benefit in both. You can get a better price and you get rates come down, and it can help close that gap. And the reason I'm harping on this move up buyer is because that move up buyer is what's going to create inventory for the first time buyers. And we need that to happen. So the focus needs to be around this idea of what needs to happen to shake loose all these people in the middle that own a home at a really low rate that's going to entice them to move up into that next category. And I think that a softening in the luxury market and an increase in interest rate, or an improvement in interest rates, gets them to move, which then frees up some inventory. You see rates come down, helps affordability at the low end, and you can kind of see how this frozen market might start moving forward a little bit.
Another thing that we're seeing too is you're seeing builders start to shrink their square footage a little bit and then change the interior features. And what they're doing is they're trying to squish their price down to make their price more affordable, because they're experiencing the same thing. If it gets too high, so Pulte, for example, said, hey, you know what? We're going to go build some smaller homes. That's America's luxury home builder.
Right.
So you're going to see more of that. And then let's flip it over to the investor side. If I'm doing a flip, I don't know if today's the market. I go flip a 3,500 square foot, maybe, mountain or waterfront view. I go flip a 1,300 square foot home though.
Yeah.
No problem.
Right.
You got a market there for it. So this is just about knowing that market, understanding it, looking at it daily, and then finding the things that create massive opportunity.
Yeah. Well, I think we covered the things that were on my list. Look, we
was mine
talked
too.
about what's going on with the banks, and we gave you some specific information about SVB, and also just some education on the pressures that banks are feeling. It's complicated stuff, I know. I hope that we unpacked in a way that makes sense for you. We talked about what the Fed's going to do. Look, they're probably not going to pivot overnight.
No.
I mean, it's if you think that's what's going to happen, I just don't think it's enough right now. I think what they've put in place is going to get them to say we're going to continue on inflation. But I think May, June, you start seeing good signs that inflation is beyond us. That's going to help rates. The Feds are going to then say, hey, we have some ammo built up. We can let some of this go and start fixing some of these other unintended consequences. You guys, that means low interest rates as far as I can tell as we get towards the end of the year and into next year. That hasn't changed. We might see a little juice earlier, which is welcome and perfect timing for the spring home buying market. But your window of opportunity because of the inventory issue is closing quickly. And then we talked about rates and housing. You guys, thank you for your time and attention. Anton, thanks for reaching out today.
Yes, sir.
And always being willing to come in and
Yes.
talk about the market. With that, you guys, I hope you're navigating this market well. I hope you're enjoying market shares and the content that we're bringing to you. If you do, please subscribe to the channel. But more than that, tell people about it so that more people can get this information on a timely manner. And we'll continue to bring you hot topics as they come out, as well as some sales ideas and trends, and trying to just hit all of the different areas that we think bring benefit to the real estate and mortgage community. And until next time, take care.